Hello, everyone, and welcome back to Your Finance TV. Recording this on a Friday, so you know what that means. It's Jay Pelosky with his weekly musings. How are you, Jay?
Happy it's Friday, Scott. I won't lie. It's been another long week with a ton of macro data, a ton of earnings data, markets, being somewhat not too happy with things. So risk assets continue to suffer. So it's been a challenge, but happy to see you and happy that it's Friday.
Well, I can feel you. As you said, it's been a very tough week for the markets, and markets are obviously trading right now as we record this show. Now, it's headlines everywhere, like just negativity, negativity, negativity. You've titled your musings "Skip the Headlines." Now, you can't just go in there like this, can you? Like, if you've got to, like, do you read some of them or you just ignore all of them?
No. You skip the headline and you read the story, right? And look at the data. And it really was that mindset, right? That headlines have been just relentlessly negative, for months and months, arguably, right? Recession, fiscal, U.S. Treasury supply, too much supply, and now most recently, growth too strong, right? So we went from recession fears, right, guaranteed recession in 2023, to now we have almost 5% growth in Q3, and it's too strong. So no matter what the headline, it's all had the same effect, which is effectively continue to create concerns about inflation and rates, and therefore stocks have struggled. And so we've also been in, one of the worst periods in terms of seasonality. We're shifting into the best period of the year, right? November, December, January, top 3 months of the year. But we have to be realistic and note that there's been some technical damage. And if you look at pretty much all the broad indices globally, not just in the US, but ACWI, ACWIX, EFA, EM, as well as the S&P, all are now under their 200-day moving average. And, the old adage is that nothing good happens under the 200-day moving average. But, and there is a but, the good news is, and our advice is, skip the headlines and focus on the underlying data, which, from our point of view, whether we're talking about U.S. growth or China growth or the inflation picture in the U.S. and Europe, or the earnings picture in the U.S., all of that data is coming in quite good, and therefore, in our view, suggests that when you add that data to the oversold conditions that we now have, to the very negative sentiment that now exists, to the massive short position in the hedge fund community, et cetera, that the year-end rally has been delayed, but not canceled. And so when we look into all of that and put all of that together, whether it's the data, whether it's the earnings, whether it's the seasonality, all of that combines to keep us constructive in what's proven to be a challenging period to be constructive.
Yeah, it's interesting. Like you refer to the headlines in the title, but I've seen a couple here just before we jumped on today. I was reading through like Nuveen saying like there's opportunities coming up here. I saw Ned Davis actually saying the next couple of months is like a good opportunity as well. But you want to dig a little bit further into this, right? And look into seeing what 2024 could hold for investors as well.
Yeah, I mean, it is that time of year, and we're getting ready to write our 2024 outlook probably in the next week or two. But as we think about it, what's shaping up to be the surprise, in our view, is that inflation is going to come in lower than expected, faster than expected. And we think that will have big implications for, obviously, developed market central bank activity, Fed and ECB, obviously rates, obviously then the lead on or the follow on to the dollar, and all of that into stocks. And so that's really how we're starting to think about things, that the setup, and we'll discuss it in a minute or two, the setup for inflation is actually getting significantly better, both in the US and in Europe. and that arguably that's going to be the surprise. And we're starting to get a couple of tells to that effect, right? So one would be that the real 10-year U.S. Treasury rate, about 2.5%, has been there now for a couple of months and doesn't seem like it wants to go higher. If you look at the nominal 10-year Treasury rate, right around 5%, likewise doesn't want to go higher, notwithstanding the blowout Q3 GDP number, right? 4.9%. Consensus was a little north of 4. A month ago, consensus was like 2. So, a blowout GDP growth number, and yet real rates nor nominal rates really moved at all, right? The 10-year today is at 4.85. And so that all leads into the dollar, and the dollar, likewise, DXY peaked back in October 4th. So now 3 weeks ago at 107.2. Today, again, after all that data, 106.6. And so it's starting to look like, the market is fully priced in the higher for longer, priced in the environment that we're at, and therefore could be ready to be surprised on the other way, right? Where inflation perhaps comes in, as I say, lower than expected, faster than expected. And here the key is to remember that both the Fed and the ECB don't expect to see 2% inflation until 2025, right? So that's where the policymaker mindset is. No, we're moving in the right direction. We've done a lot with raising rates. We're on hold, but we really don't expect 2% till 2025. What's shaping up from our view at TPW Advisory is that we may actually get within sniffing range of 2% next year, perhaps even earlier than before mid-year, which would be a major surprise.
Okay, and so you talked about it a few weeks ago, or maybe 2 weeks ago, about your 4 signposts. Now, obviously, markets have changed a bit during this week, but has anything changed in those 4 signposts?
That's what's great about having the signposts, right? Is that there's something that you can kind of hang your hat on as you navigate through these tricky periods, particularly when markets aren't going your way, when a lot of data is hitting you in the face every day. It's really, we've found over 30 plus years in the business that having a process is key. And we have our tripolar world process that we've had for a decade or more. And then having signposts, like what are you looking for? What's important? What do you pay attention to? And we've identified 4, right? So quickly, to go through an update, the first is continued disinflation in the US and in Europe. And there, as one would gather from my earlier comments, we're getting increasingly comfortable that disinflation is on track and maybe even accelerating. So next week, Europe reports its October CPI. We expect that to have a 3 handle on it, right? Not too long ago, inflation had a 10% handle on it in Europe. So Europe's already going to be at 3%, we think, coming up next week. In the United States, the data continues to be really constructive. And in particular, we look at the core PCE data that came in today, for example. Q3 annualized was running at a 2.6% rate. That compares to Q1 this year when it was running at 4.8%. So almost a halving just from Q1 to Q3. In addition, the PMI data that came out earlier this week was very, very constructive for inflation, coming to within the 2% range early next year. And that's a quote directly from the S&P Global people who produce that PMI. And that leads us into the second signpost, right? A global manufacturing recovery. There too, the data has been good, with both the US and China manufacturing PMIs coming in above at 50 or better, which is the dividing line between boom and bust. And the conditions for demand in the United States in September were the best they've been since the spring. And the outlook is that the inventory shift from destocking to restocking, which we've been talking about for quite some time, very visible in Q3 data, and we expect that to continue. And then within the third, the kind of the laggard on the manufacturing side, Europe, looks like Europe is bottoming, and the expectations surveys and the ZEW and IFO surveys were both, expectations-wise anyway, better than expected. So that's two. The third is earnings, and simply put, JP Morgan came out this morning with about 30% of the S&P reporting so far. Year-over-year earnings growth in the U.S. is running at a plus 12% year-over-year. Consensus was plus or minus 1%. Guidance looking into 2024 has been muted, so not a lot of raises for guidance, not a lot of reductions. But let's remember, consensus currently for 2024 earnings growth is 12%. So this is one of the reasons why we're not buying into the crash rhetoric that's starting to really permeate and ricochet around Wall Street, in large part because earnings are fine and valuation is not overly demanding. I'll give you an illustration, right? The big tech companies, big cap tech, trades at 0.8 times PE to growth, right? That's typically how you measure the fast growing segments of the market, PE to growth, not just straight PE. PE to growth ratio for big tech, 0.8. S&P PE to growth, 1.5. Big tech is actually quite cheap relative to the broad market on a growth basis. And so again, hard to really argue with a complete derating of tech, as some are now starting to talk about. And then fourth and finally, the fourth signpost is China, right? And what we call the drips and drabs of China policy actually starting to gain traction. And there too, the data is solid. Q3 GDP came in much better than expected, led to a number of firms raising their second half 23 and 2024 GDP numbers to roughly 5%. So China seems to have stabilized, economy growing at roughly 5%. So this is an economy, keep in mind, that's almost as big as the United States, that's growing at 5% per annum. And the policy mix is getting better, right? Targeted fiscal, really for the first time, leveraging the central government balance sheet, which is unconstrained, to deal with the local government property issues, which are a problem. So China continues to move methodically, no big bazooka, but move methodically down the path to using policy to address the growth issues, and therefore, continue to generate 5% GDP growth. So we put all four signposts. The data flow over the last couple of weeks has actually been quite good and supportive of our thesis, and therefore, again, another reason why we're not going with the crowd and being aggressive sellers here.
Okay, well, when we take all of that in, and you touched on this before, you're just about to start writing your 2024 outlook, touched on a lot of points that will probably be in there as well. Is there something extra that we should be looking for that outlook when it comes out?
Yeah, I mean, that is the question of the day, right? And we want to focus on 2024. We always have to remember markets are forward-looking, discounting mechanisms. So the thesis is that everything that's coming out today is already known by the collective hive mind of the market. And so we are looking at 2024, and our setup, as we're starting to think about it, is as follows. So decent global economic growth. Europe, the weak sister of the three tripolar regions, Europe, Asia, and the Americas. Europe bottoming. As we speak, we expect inflation to come in faster than expected, which will allow the ECB to start cutting rates early in the first half of next year. China, just discussed, growing at 5% per annum, going to be able to sustain that as it works through the property side. As confidence returns, consumption picks up. China should be fine and helping the rest of Asia. Japan, by the way, likewise in good shape. Inflation data there coming in strong, which supports an abandonment of yield curve control. And then in the United States, we're looking for 2% type growth, inflation coming in faster than expected, Fed done, Fed on hold, higher for longer, pretty much priced in. And that DM rate hike cycle we've been dealing with for the last 2 years shifts to an emerging market-led rate cutting cycle. And we would just note that Chile, which is one of the leaders in the rate cutting cycle in the EM, just cut rates for the third time this week. So the worry is that technical damage has been done, right? As we touched on, 200-day moving average now resistance for most of the broad indices around the globe. We've given back a good chunk of the outperformance we generated in the first half of the year. That's always frustrating. But as calls for a crash grow louder, we continue to look at the data. We continue to look at earnings growth. We continue to look at the positioning, the sentiment, the seasonality. And when we stack all those things up, we feel like it's right to remain constructive, particularly in places where we think the risk reward is really attractive. And there, as we've noted in the last couple of weeks and even discussed on the China bull and bear debate, that China looks to us to be a pretty attractive place on a risk reward basis. And so we're holding to that conviction. We'll explore and expand on that 24 outlook in the next couple of weeks. But, you know, for now, we're saying skip the headlines, pay attention to the data. Earnings are doing fine. That's a big support for equities down here. Technicals may be running things day to day, but longer term, the setup looks pretty decent to us.
Well, Jay, with the week that you've just had, like, surely you're just going to sit back this weekend and just relax, not watch any football or anything like that, right?
You're giving me my little Duke football lead-in. No, we have another big game this week. It's great for Duke football fan, Duke sports fan, Duke fan period, to have like regular big games, big football games in the fall. We've had 3 national TV games with a total viewership of 15 million folks, which is a big number for Duke. And we have what's being called by the college press as the number 2 game this weekend when we take on Louisville at Louisville tomorrow afternoon. So not a night game, but an afternoon game. And, you know, we have to say that we have a special rooting interest here at TPW, and that is that QB2 for Duke, Henry Bellin IV, was our summer intern this summer. So if QB1, who was injured late last week, can't go, we have TPW's Henry Bellin IV to lead us to victory tomorrow afternoon. So go Henry, go Duke, and thank you for the little advertisement.
Well, good luck, Henry. And I'll be watching the Rugby World Cup. I'll be going for New Zealand, even though I'm an Aussie. They're playing South Africa. And I'll be watching the Aussie cricket team in the morning as well. But you have a great weekend, Jay, and good luck with the game. And we'll be talking to you again next week.
Excellent, Scott. Enjoy the rugby. Not quite as good as American football, in my view, but you may have a different point of view. But hey, that's what makes a market, right? Enjoy.
No one's bearish on either side of it. All right, Jay. Thanks very much. And for everyone else out there, good luck investing.